Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach, and today we have back with us Josh D. Millang, who's president of Retirement Protectors. We'll be talking about IRA maximization concepts. Josh, welcome back to the program.
Hey, thanks, Mike. Happy New Year, buddy.
Yes, it's amazing how time flies, right? I mean, we were talking about that before we started the interview here, and time just goes. It seems like you look up and boop, another year's gone. So some of these things that we need to take care of for ourselves personally and professionally, boy, you better just take action. Because another year's going to go by, another year's going to go by. Maybe an opportunity moves, maybe an opportunity gets worse. So learning about IRA maximization, I'm sure you would agree that time is of the essence, no matter what the age of the client is, right?
Yeah, no doubt. Yeah, it's about a couple things. Number one is accumulation. Number two is distribution. So as you know, our clients are kind of right in the window between accumulation and distribution. So that's a big focus of our health, wealth, and legacy work. But yeah, certainly as people are working, it's imperative that they, are considering these concepts, to get to retirement. So
yeah, and I love maximization concepts. I want to learn about concepts that will maximize anything. And today we're talking about IRA maximization. So let's first start with what exactly is an IRA?
Yeah, thank you, man. So a couple things on that. So IRA, really, when you hear about it, is a pre-tax investment vehicle. So you hear the term IRA. There's also Roth IRA that's thrown out there. Roth IRA is after tax, and we'll talk about that in a whole nother segment. We're just really specifically talking about the pre-tax IRAs and that sort of thing now. There's a bunch of different things too that we'll cover in terms of different IRA types and different pre-tax investment types. But there's a bunch of different laws and rules and things like that as far as with the different types, as far as your limitations based on your age, based on your income, all these different kind of things. But yeah, we're just going to kind of cover really what some of the things that you can do to really maximize the value of that for your legacy and for your wealth plan. And
IRA stands for what?
Yeah, it's individual retirement account is what it stands for specifically.
So like if you were, or if a big company, if you owned a huge, massive company, you might offer a 401k or a retirement account, but this is an individual retirement account. So individuals then need to be looking at this for as one of their vehicles, maybe not all your eggs in this one basket, but now we know an individual retirement account. What types of money can be in it? You mentioned pre-tax, because a different type of an IRA like the Roth is after tax, but what kind of money pre-tax can go into an IRA like this?
Yeah, and you're just like the king of the segue with me, man. It's almost like I gave you my notes ahead of time. So one of the things that I want to bring up in the kind of what can be in an IRA thing is the different things that are pre-tax money that are considered retirement accounts. So you brought it up specifically, and if you do work at a big company, a 401k is pre-tax money. So that is something that if it's at work, it's probably called a 401k. If you work for a normal for-profit company, they also have things called 403b or tax sheltered annuities or TSA. If you work for other types of companies, and then they have 401as and 457s depending upon your employer and things like that. But those are really all pre-tax vehicles that can be rolled without a tax penalty into an IRA. So you can also, with most of those vehicles, make contributions to an individual IRA along the way, Mike, as you're making contributions to your work plan and that sort of thing. But so when we talk about IRA, we're kind of talking about the universe of those things that can be in that pre-tax bucket, including your work plans. But then also, really, in terms of investment vehicles, IRA is really more of a taxation term, meaning it's pre-tax. So that's kind of the concept here. So in a pre-tax vehicle like an IRA, you can have all kinds of different investments. Think of it like an umbrella. Like under the umbrella, you can have a bunch of different investments. So like some people have their IRA in a CD at the bank or a money market at their advisory firm. Some people have their IRA invested in annuities. Some people have their IRA. I've heard commercials that you can put your IRA in real gold bricks or something like that.
Interesting.
So, but mutual funds, investment advisory or fiduciary accounts, you can invest your IRA in all kinds of different things. So we're less kind of talking about those things as we are some more general concepts today, though.
Yeah, I think that's really curious. What can be in an IRA? A variety of types of money. And that's what's interesting. Like, I think a lot of people have a misconception like, oh, I heard that IRAs are, well, you might want to talk to someone that can go, yeah, but you didn't realize that you could. And then this opens up the door of, so I think that's a big important thing that people should put a pin in and realize, look at your specific situation. What are some alternatives and opportunities within the umbrella of the IRA that we could talk about? So that's really huge. You mentioned annuity. So what is an IRA annuity?
Yeah, so what we'll talk about really in that, generally annuities are designed to create a few different things, whether it's income now, income later, deferred growth, a bunch of different types of things. They're kind of a Swiss Army knife of investment vehicles. Sometimes people sort of get confused because within a traditional non-qualified annuity, you actually get tax deferral just like you do with an IRA, but it goes in a non-qualified annuity, it goes in actually after tax, grows tax deferred, and comes out taxable. So you can actually have an IRA invested in your, you can have an annuity invested in your IRA, but the taxation of the IRA supersedes the tax benefits of a traditionally non-qualified annuity. So that's definitely one of the few things that we'll cover. I did forget, I had on my notes here just to kind of clarify when we say pre-tax, like what does that mean in English? So you've got gross income at whatever your W-2 or whatever you have in terms of your operating income from your business. And then whatever contributions you make to an IRA or a company-sponsored retirement plan comes off of your gross income. And that creates a net income. And that's actually what you're taxed on. So that's how, when we say pre-tax, that's how it's sort of created.
So it goes into your individual retirement account fund before the government tax on all of the different personal income taxes.
Correct. Which is logical and reasonable when you get a paycheck, because the paycheck says, X, and then your contribution is Y, and then the net amount is Z, which is what you're taxed on. Yeah. But when you're physically writing a check into whatever your IRA is outside of your company sponsored plan, it's kind of like, well, this is after tax money. I have it in my checking account, But there's notices that go across between the IRS and these companies that notify of contributions and distributions and stuff. So that's kind of the mechanics of it. I want to make sure and hit that.
And so, like, for instance, what if someone is working for a company and let's just use the number 5%. The company will match 5% of whatever you put into their 401k. So theoretically, just as an example, maybe the person should contribute up to 5% to not leave any money on the table. But then after that, let's say that they still pay all their living expenses and they have some money to invest. Maybe an IRA would be a good way to do that. Are you saying that then they would instruct their company to then contribute to another account, this IRA account, before tax?
Yeah, that would be something. Yeah, it'd be before tax. That'd be something they work with their individual advisor or registered rep or whoever on. That's where they can make additional contributions depending upon their age and their income, and some of these other limitations into that as well. So we're kind of talking about all this stuff sort of under one umbrella, and really how to use something that is, like we'll talk about, I think next, with these minimum distributions, something that is built for accumulation, but is also kind of forced distribution, meaning like when you turn, it used to be 70 and a half for 100 years. So when you turn 70 and a half, you had to take a minimum distribution, and it's like just over 3.5%. They changed that a couple of years ago now to age 72. So, Mike, what that means is you can accumulate this money, you put it in pre-tax, it grows tax deferred, meaning you're not going to get a statement from the company every year that you have to pay taxes on any money that it's grown to. And then on the way out, it's fully taxable. So that's, the idea being, you're generating a lot of revenue while you're working, and your tax bracket's going to be higher. And that when you retire with a lower tax bracket, even if you pay taxes, the amount on your distributions out of that should be taxed lower. Well, what they say is, that's cool and all, but like by the time you hit 72, if you have, you need to start taking money out of here, whether you like it or not. The government's got these required minimum distributions that say, look, you haven't paid taxes on this since you started putting it in.
We
We're
want a
going to
little
need to
bit.
start paying some
Yeah,
taxes.
we want a little piece of your action before it gets too late. So at age 72 now, you need to start taking some out so the government can start taking a little bit of shaving off of that distribution in taxes. So the required distribution, they start at 72, but then every year you have to take out a certain amount. What does that look like?
Yeah, great question. So how it works is basically you have to take it based on the sum of all of your qualified accounts at whatever the balance is on December 31st of the previous year, meaning the year that you turn 72, whatever the balance is at the end of that last year of all of your qualified accounts, that's the basis that is calculated off of. And then there's an RMD table, which you can talk to your advisor about, which starts at 72 now. It's about 4% of that total qualified account value, meaning by the end of that year, you have to take about 4% off of that. Otherwise, you'll trigger a 50% IRS penalty for what you should have taken out, which is brutal. So so if you got $1 million account, you've got to take whatever that's $40,000 out of there by the end of that next year. So that's kind of how that works. And then the other thing about it is you don't actually have to take it from each account. If you have, multiple IRAs at different investment advisory firms or different insurance companies or whatever, you've got to take that $40,000 in that example from them, period, whether it's from one of them or all of them or a couple of them or whatever. So the companies will notify you based on whatever the value is with them, what the RMD would be from them. They don't know about, company B, C, D, E, and F, right? So they've got to legally notify you, hey, Mike, on this account, your minimum distribution for next year is X. So, but you don't have to take X from there. You can take all of the sum of them from one or more of them. So there's some flexibility there that could take some strategy to really maximize. So we do a lot of work with that. And then as people get older, the percentage that they have to take of that basis increases. So therefore, when you get into like your 80s, you're up in that like 5 and 6 range. So you've got to start taking 5 or 6% off of that end of the year value as you grow. So it's really interesting. They start getting pretty aggressive about making you take your money out and paying taxes on it.
And that kind of ties back to what we've titled this as IRA maximization concept. So what you just described was you better know what you're required to do, or else you get hit with a penalty. So work with a advisor like you guys, because that's huge to be able to avoid a penalty. But then when you take that distribution, what if you don't need all the 4% or 5 or 6%? Well, then you better do something smart with that money, because you have to take it and pay your taxes on it. So what then would you do to maximize that? There's many things that I know you would advise clients to do, but the point is it sounds to me like a domino effect of if this, then that. If I don't take it out at the right time, I get penalty. If I take it out at the right time, I get taxed. But then what if I don't use it? I need to do something with the remainder of the money that's pretty smart, so that I maybe am growing some more to avoid taxes and things like that. So maximization, that's huge. And you did a great job accumulating over the years, but now you're age 72 for whatever it is. Here's what the strategy is moving forward.
Exactly. So, bottom line, the two things that are really certainties on this is you have to take them, number one, and number two, you're gonna have to pay taxes on it at ordinary income. So if you have to take it, you have to take it at ordinary income. What we try to do is do the best we can with that after tax amount of money to try to offset the taxes and really try to offset what's going to happen when it goes to your beneficiary. So generally in IRAs, if they go to your spouse, it can be a spousal continuation IRA. There's a couple other rules that effectively make it so that your spouse doesn't have to pay taxes on the whole entire amount, depending upon the vehicle and some other specific criteria. But if it goes to your beneficiaries that are not your spouse, i.e. your children, that is a fully taxed at ordinary income bomb that they're going to be receiving
to them.
So, we look at that and people go, oh man, yeah, that's, anytime you ask our clients, their kids are always doing better than them because they're awesome parents and they raised incredible kids, this guy's so successful and this dude's a doctor and this guy's a successful entrepreneur and whatever. And, and they're like, oh yeah, they're crushing it. They're doing way better than me. And it's like, Okay, so they're at a pretty high tax bracket, right?
Yeah.
Okay, so you're going to be, if you've got, I joke about this, but I'm not joking about it. If you've got three beneficiaries, you really got four. It's your three beneficiaries and your Uncle
and
Sam.
Uncle Sam.
And
Right.
honestly, and it's no joke, because if you've got your kids at a fairly high tax bracket and they're paying let's say a third of their taxable income at federal ordinary income taxes. I mean that's a third of it. So you got three kids. And you got $1 million IRA, that's $333,000 a piece. Each of them are paying $100K on taxes. So they're netting $230 each. And that fourth beneficiary, the government, is getting, $300. So they're getting more. He's getting more than your kids are getting. So what we try to do is make sure that we're allocating the not only after tax amount that you get off your minimum distributions or your withdrawals, but also that amount, that ultimate amount that's going to transition to your beneficiaries, making sure that we do it in a tax efficient manner. Because man, that's brutal. I mean, you saved a lot and your kids are doing really well. Those seem like dream scenarios, right? And then the government's like, oh yeah, worker, those are dream scenarios for us.
Yep. Thank you.
Get you on the distributions, get you on the on the estate.
Exactly. So definitely many moving parts with maximizing inflow, outflow, legacy, taxes, all of that. You mentioned annuity before. Are there special considerations to keep in mind for an IRA annuity?
Yeah. So if you have your annuity, if you have your IRA and an annuity now, a lot of those have a couple different features that we really like to leverage for people. Whether it's a variable annuity or an indexed annuity or fixed annuity, whatever, a lot of people who have those that are tax qualified or IRAs, they have things on them called either guaranteed minimum income benefits or guaranteed minimum withdrawal benefits or something that kind of sounds like that. A lot of people put those on there because, and we'll talk about this in greater detail in a minute, but they can guarantee, regardless of what happens with the market, your account will grow into the future for income standpoint. So your account value fluctuate based on the underlying investment, whether it's in the market or it's in an index or whatever. But the income benefit will grow over time, no matter what happens. There's a lot of different, there's a bunch of different calculations and things like that on them. But the bottom line is, Mike, oftentimes when we start working with people who are retiring, they've purchased one of those in the past to protect themselves as they kind of set their glide path into retirement to protect their assets from the volatility and from an income standpoint. What we see is a lot of people haven't activated those benefits, and those benefits are generally between 1 and 1.5% fees, and they're in most cases totally worth paying, because whether the market is up or down or flat, they're getting increases over time until they start taking that money. But what we see is, number one, the amount that it's charged off of is based on the income value, not the account value, which is just something. So for example, let's say you've got a $500,000 in an IRA annuity and you're about to retire. You may have one of those guaranteed income things that's worth like $1 million, depending upon how long you've had it in that account, which means you can take income off the $1 million rather than the 500,000 because you've been paying for this benefit. The cost of the benefit, though, is 1 to 1.5% of the $1 million, not of the 500,000 So they can get kind of expensive. But the thing about them is, a lot of times people don't even activate them. So what we're doing is we look at that account, Mike, and go, dude, you've got, if you roll this money to your wife, you've got $500,000. This money goes to your kid, you got $500,000 fully taxable to them based on their ordinary income. But you've got this income thing you've been paying on for however many years, and it's worth $1 million. And off of that, we can take, like, let's say $65,000 a year off of that. And turn that into as much tax-free money, either for your income or for your beneficiaries, as possible. And people go, really? So they have these things in place. And that's why we want to talk about, the first thing was existing, IRAs that are in this type of thing. Because a lot of the work we do is say, gosh, man, you've been paying on this thing and it's done an amazing job through ups and downs in the market. Let's activate it. Let's activate it and turn it on. And what oftentimes we're able to do is, let's say, take that, whatever the income benefit is off of that, and actually turn that into doubling the amount of money that's going to go to your state by using some tax-free vehicles. So Now you go and have, let's say, 600, 700,000 bucks after taxes to your kids. We can turn that into like a million, 4 million, 5 after taxes to your kids using some of these strategies. So even when you have stuff already invested, there's a lot of things that we can do to sort of educate you on what they have done and are doing and will do for you, and create some really incredible results for you, from an estate, after tax estate, and from an income standpoint.
I think that's the big piece people need to remember is I'm looking forward to my future for legacy, for planning to support my family with my, wealth. Don't let it sit with just, look at this big amount, it's going to go to them. Make sure you see it through to what will happen on the other side of them receiving it. And sometimes there's things that just are, like, we're going to have to deal with taxes. Yeah, we get that. But would there be opportunities to mitigate, lessen, maximize that for the benefit? And that's what we're talking about here. So I think that's such a huge piece to keep in mind. What about kind of the same way as 401k and mutual funds, and like, I don't know where to put the money, and what about if I'm worried about the markets or income? Are there? I've heard of this, and correct me if I'm wrong, but I've heard that there's some type of IRAs where you can use the funds in the umbrella of the IRA to even buy real estate. What are some creative ways people can use their IRA for if they're concerned about the market and income?
Yeah, there's alternative investments. Really, almost anything, any investment vehicle that you can find, you can get. You can put it in an IRA. So whether it's there's real estate, you can invest in business development companies and private placements. There's all sorts of stuff depending upon the license that your advisors hold. But there's some really interesting alternative investments from that standpoint. But really, from someone who's concerned about the market, I'll mention a couple things for these last two things. So either number one, I'm concerned about the market between now and the time I retire. Number two, I'm concerned about my income between now and the time I retire. So with that first one, what do I do if I'm concerned about the market? A lot of times in people's existing company-sponsored retirement plans, or even their IRA, if they've got one of those outside of work, there's limited investment options depending upon where it's at. So like if you got it at a bank or somewhere else in an IRA, there may be, not mutual funds, but it may be a CD or a money market or something like that, or a savings account limitation. If you got it at work, sometimes these company-sponsored plans, they may have a couple dozen individual funds and a fixed account, and that might be it. It might be even less than that. Some of them I've seen have investment funds that they put you in based on your age, regardless of whether you want it or not, and you can't switch it even if you want to. So depending upon your plan and your company and stuff, there could be more or less limitations. But what we have found over time, working with people approaching retirement, in almost, I'm going to say most, not all, but a huge majority of plans will allow you what's called an in-service withdrawal. And what that means in English is at age 59 and a half, you're able to roll in most plans up to 100% of the current value of your company sponsored retirement plan out into an IRA. And once you do that, you have access to all of the different things that are available in kind of the investment universe, rather than the limited options in whatever plan you're in. A
fixed plan, corporate plan. Yeah.
Correct. So that's a big thing at 59 and a half. And that allows you also to, in most cases, stay in the plan, continue any contributions you have, continue receiving any matches you have, any profit sharing, ESOP contributions, anything like that. It doesn't kick you out of the plan. It just allows you to say, look, I'm approaching retirement and like, I want to get some of this out of here, and put it into an IRA. So from a market, people concerned about the market standpoint, we do a lot of work with IRAs for people that are in accounts that are guaranteed not to lose money if the market is down. If the market is up, they get a percentage of the market. But if it's down, you're guaranteed not to lose. So a lot of what we do with those 59 and a half, what they call in-service withdrawals or rollovers, is we help people roll those directly, without paying taxes from their company plan into an IRA. And then we can put them in things that are guaranteed not to lose. There's a bunch of different indexes available depending upon the products and stuff like that. So it's really a matter of sitting down and kind of building out a plan with your advisor. But there's some really cool stuff out there that can really help, like you say, mitigate that concern about the market, and then still go on your merry way at work, and your account value starts at either zero or whatever you left in there, and then contributions, matches, profit sharing, whatever, and grow it back up until whenever you retire. But Mike, being able to have, up to 100% of that asset now in something that is in your control, not at work, that is in something that gives you confidence, not that you're kind of at the mercy of the existing investment allocation options. So we do a lot of that, and it really gives people a lot of confidence as they approach retirement.
That makes a huge, that makes a lot of sense. I remember I've been out of corporate America for probably 18 years, but I remember back when I worked for a big mortgage investment banking company, my 401k was in, and it's like, I'd get these big, thick books of here's your distribution. And it's like, I have no clue what this is. Don't even, and let's not even start talking about if you get a human on the phone, it's this big black hole. And so to your point, you might have mindlessly for a decade or two just taken that distribution. That's wonderful. And had your money put into that 401k. Well, now maybe you're at an age 59 and a half where it's like, okay, I'm starting to see the on the horizon where retirement, and maybe you do take that special rollout. Don't try to do it on your own, but what if you do put it in an IRA where you didn't take any tax hit because there's no penalties going into an IRA, and then that opens up a lot of these worlds of opportunity with, guaranteed or very low risk, and then you as the client, what the money's doing, because it's like, you know what, I kind of have a passion for X, and you said that you've got an alternative investment of this that fits or real estate or whatever the case is, but it's a whole lot more clear than that big, thick 401k, allocation book that you tend to get.
You got it, man. You're right on.
Huge. Now, what about a Roth? That's an IRA, and that's after tax. Is that another strategy where it's like, okay, let's maximize a regular pre-tax IRA, but then there could be an opportunity for a Roth as well?
That's that's a whole other call. Really Roth strategies and Roth IRA alternatives and things like that. That's literally an entire other call of options and
but just know that in the world of IRA maximization that we've covered here, there's yet another trail to go down, working with a qualified retirement planning specialist like yourself to put a pin on Roth and go, how would that benefit me? And again, with all of the things that a retirement investment advisor will talk about, you should never go, that sounds good, I'm putting all my eggs in that basket. Nope, it should be a nice balance. What are the best balance accounts for me? And so this has been so helpful to talk through IRA maximization concepts. And so if anyone is interested / concerned, right? Because some of these things we talked about could raise a concern, like, I wonder if, and I'm worried that this might be a ticking time bomb in my situation. If someone wants to get more information and reach out and connect with you and have maybe you give a look and say, hey, don't worry, you're in good shape, or we need to do this by this date, what's the best way that they can learn more and then reach out and connect with you?
Yeah, man. Thank you. And to your point, it's the concern that makes our phone ring rather than the interest.
Yeah.
It's not people saying, gosh, I'd like to talk about something different. It's like, oh my gosh, I'm concerned about what I have. I wonder what my options are. So, but we do have, we have a great website, www.retireprotected.com, as in we want you to retireprotected.com. And then also our main office in our Des Moines main office location is 515-992-5000. And really just reach out and we'll educate you on what you have, let you know if you have any options on any of these type of things, and help get you educated and see if there might be some options for us to add value to your legacy, your wealth.
Excellent. Well, Josh, thanks again for coming back on. It's been a real pleasure talking with you, and I really appreciate your time.
Thanks, Mike.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneursradio.com.